In the last 10 years, we have completely transformed this. And it's a story that even the government doesn't advertise, which is that our oil dependency has gone down by almost 60%. Trailing 12 months, India imported 1.7 billion barrels of oil net on a $4 trillion economy. So our economy has quadrupled since 2008. Our oil import bill is up 80%.
And with Ridham Desai on my side, you can very well assure yourself that it will be even more exciting. Uh, this session is about why you are bullish on India. Let me ask you a completely contrarian question. Have you ever been bearish on India?
Yeah. I have been actually.
When and under what circumstances?
No. So in January 2007,
Uh-huh.
I had written a report called Skating on Thin Ice
Okay.
and had predicted that the Sensex will go down to 11,000.
What was it then?
It was about 15.
Okay.
However, of course, I went totally wrong because in the subsequent year, it went to 22,000.
2000.
By the end of 2008, it was down to 11.
Okay.
So my call was a bit early, but in 2007, I was very worried about the incessant appetite for IPOs,
Mm-hmm.
about the valuations of the market,
Okay.
and also the excesses in earnings, because
Okay.
profit share in GDP had hit a peak, so margins were peaking out. So the view was that earnings will slow down,
Mm.
that the IPO boom will cause a technical issue, and then the valuations will give. But it took a little while because the world was in a tearaway bull market, and it wasn't.
All
Yeah,
boats were rising.
it wasn't until January 2008 that played
Yeah.
out.
Yeah.
But yeah, I was bearish then. I was a little bit concerned in 2013, but that was a very short cycle.
Mhm.
I have to say I've been bullish since 2014.
Okay, that's
Now,
right.
so
That's
this
right.
is the 11th year of my
Yeah.
bullishness,
I,
and that doesn't mean that the market will deliver absolute returns every single year,
that's right.
because I keep reminding people that equities is the longest duration asset class in the world, and you have to have a longer term view. It's not a fixed deposit, it's not a bond. uh, Minimum 5 year view has to be had. If you can't afford a 5 year view, you shouldn't be less than three. If you want to do equities for 12 months, good luck.
Okay. So, from being bearish to being bullish for the longest duration of time, uh, what has changed? What made you bullish? What are those macro variables, as they say, which underpin your constructive view right now?
See, there's a fundamental change that has happened in India, and it is not what people in this room are thinking.
Yeah.
The fundamental change has happened on our saving deficit, or what we call as current account deficit. The current account deficit technically is the gap between our saving rate and our investment rate. And India has historically always had a higher investment rate compared to saving rate. So we've had a higher current account deficit. And behind this, the reason is because we had very little to sell to the world, and we had to import our energy requirements. And it was very large quantity of energy that we had to import. So at any point in time, we ran current account deficit, which would be between 2.5% and 5%. Now, historically, this current account deficit was largely funded by flows from the capital markets, because we didn't really attract much FDI. See, putting up manufacturing units in India for a multinational company is a nightmare. And therefore, multinational companies preferred not to do it. If they wanted an operation in India, they would go and acquire something that was already on the ground. So we always struggled for FDI. So we would get funded with capital market flows, and largely equity capital market flows, because our fixed income markets were close to foreign investors.
Correct.
Now, equity market flows tend to be very cyclical. And in fact, they hit a trough exactly when it goes against India's cycle, which is during US recessions. So when we most need it, they actually vanish. So in 2008, as an example, India had nothing to do with the global financial crisis. Our banks were absolutely fine. And I was discussing this with Tamal before this session that, the RBI was already anticipating problems, so had already tightened up. Our banks were in very good condition, but we were the second worst performing market in 2008. And that was largely because the global capital market cycle turned and we lost access to flows. Now, I'll come to this point a little later, but I'll still make it today. And this happened at a time when oil prices were going up because
That's
there was
right.
a supply shock in the oil market. And people in this room may not recall, but in July 2008, for reasons that were completely separate from financial markets, oil price hit a peak of $148 a barrel.
And
And
Goldman Sachs was talking about
correct.
$200 a barrel.
You've got good memory. And by the way, we have never gone back to that level since.
Yes.
Okay, so since in the last 16, 17 years, oil has never gone back. It threatened to go back during 2022, but it never really went back. Now, just, I'm going to digress a bit and keep this math in your head. India had just become a $1 trillion economy then. And how much oil were we importing? On a net basis, we were importing 900 million barrels of oil. Now at $148 into 900 million, that is $140 billion was our annualized import bill in the month of July 2008. Nobody on the planet will fund 14% of your GDP
Yeah.
because that was 14%.
Yeah.
And so we crashed. We had to. The rupee had to go down, interest rates had to go up, and stock markets had to react to this. So that was our situation then. In the last 10 years, we have completely transformed this. And it's a story that even the government doesn't advertise, which is that our oil dependency has gone down by almost 60%. Trailing 12 months, India imported 1.7 billion barrels of oil net on a $4 trillion economy. So our economy has quadrupled since 2008. Our oil import bill is up 80%. Now, oil is, of course, at $60, but let's assume it goes to 140.
Yeah.
Right? 140 into 1.7 billion barrels will get us to about an oil import bill of 325, $330 billion, which in a really worst case scenario will still only be about 6% of our GDP. So even if oil went back there, which it is not going, oil is no longer consequential to our current account. And this fundamental change means that we are now not running such a large saving deficit. Now, on the other side, something quite good has happened to India in the last 5 years, and this is the silver lining of COVID. So, COVID was bad news for everyone, but one of the good things that happened was that typical MNC CEOs realized that it's okay to work from home. And if you're going to work from home, you might as well work in Mumbai. It's a whole lot cheaper than working in Florida. A lot of Americans went back to Florida and to warmer places during COVID. But Mumbai tended to be much cheaper and you could hire talent at scale. So what we have seen in the last 5 years is a big boom in what we call as GCCs or Global
Yeah.
Capability Centers.
Centers.
They exported circa $70 billion of services last 12 months. And this is a secular shift that has happened on the planet, AI or no AI. And if you want, we can investigate this later. But this 70 is probably going to double in the next 4 or 5 years. Now, this is unlike IT services. IT services are also cyclical because they depend on US growth in large part. And when US growth goes down, IT services growth also goes down. And that happens exactly at the time when India most needs the money. So, as a consequence of the lower dependence on imported fuel and the emergence of a secular export for India, this has meant that our current account deficit now is largely less than 1%, probably 0.5% of GDP. And 0.5% is about $20 billion. And $20 billion is loose change in the global markets. Fundamentally, we are no longer as dependent on FPI flows because FDI has become more viable. And so this has completely altered India's external dynamic. Now, the consequence of this on the stock market. So, what is the consequence? Now, also something else happened in 2015, which is that we migrated to flexible inflation targeting. And the consequence of that 10 years on is that our inflation volatility, forget headline inflation rate, certainly gone down, but inflation volatility is the lowest in the world. Now, understand what this means for the stock market. When inflation walls go down, your growth, interest rate volatility goes down. If interest rate volatility goes down, growth volatility goes down because all growth cycles are produced from interest rate cycles. And if your growth volatility is lower on what is a pretty good headline 10, 11, 12% growth that we're doing, it means that the numerator, which is what drives equity valuations, is looking very attractive for equity investors. In the denominator, which is basically the discount rate, I would argue, and I won't be surprised if this unfolds in the next 2 or 3 years, given the lower saving rate that saving deficit that we have, the lower current account deficit that we have, it means we can actually fundamentally run lower real rates. So historically, we have had to run higher real rates for the fear of our current account deficit widening. Now we can run lower real rates, which means interest rates in India will be lower than they have been historically. And for anybody who understands equities, PE is a very bad way of judging valuation. You judge equity value by discounting future cash flows. The discount rate is falling, the future cash flows are more predictable. What happens to the PE multiple? It goes up. At 20 times, India is cheap. And who knows this best? Our domestic investors, which is why domestic flows are strong. It is
Okay.
not the other way around. It is not because domestic flows are strong that the PE is elevated. The PE has gone up because fundamentally India has changed, and that is why domestic households who are probably much smarter than foreign investors are making this fundamental shift in their balance sheet. In 2015, they had just 3% of their balance sheet in equities. Today, that number is 7.5, 8%. I won't be surprised if it goes to 20. The number is 50 in Europe, 40 in America, 20 in a conservative society like
So that's
Japan.
possible.
Oh, yeah, easily possible. So when people ask me, when will the domestic flow stop? I say, not in my lifetime.
Okay. May you live longer.
Yeah, I do worry about living longer.
Yeah.
But
Yeah.
yeah, I think it's not changing in the next 20, 30 years.
You made a very interesting, gave a very interesting equation from a macro point of view. What you are saying is that we are becoming less dependent on the FPI flows. We are more dependent on a little bit of FDI. I mean, whether it is net or gross, let's not get into that debate. But remittances have also done very well in this period. So haven't remittances also played a big? India is the largest remittance recipient country in the world right now,
Yeah,
which it was
remittance,
not.
but remittance is part of the current account. So that number is already netted off in that 0.5%.
Yeah.
That is, including remittances. So that is not funding. What funds the current account deficit is either FDI or FPI. And FPI now comes in both equity and debt.
That's right.
So, but the material point is that the absolute number that India needs is about 20, $25 billion, which is really nothing.
Nothing.
So we are not so dependent on global capital market flows like we used to be. And when you're not dependent on global capital market flows, what happens is the beta of the market goes down. So
Okay.
India in 2013 was a 1.3 beta. So I don't know if everybody in this room understands beta, but it was far more sensitive to global conditions uh, than it ought to be because we didn't have such exposure to the global economy, but we had exposure to the global capital markets. Today, India's beta is zero point 0.4. It's a
Uh-huh.
quintessential defensive market. So when you're searching for explanations as to why India has not done well this year, the most proximate reason is because we've been in a raging global equity bull market. And India is not going to do well. It's a consumer staple stock. Consumer staple
That's
stocks
right.
don't do well. When the next bear market arrives, India will flourish. It's a zero point 0.4 beta market. It will be so defensive, everybody will want to own India. So that's one of the reasons. Of course, there are other reasons why India has not done well on a relative basis. And just to, uh, this audience may already know this, but if you look at the top 20 markets by market cap, trailing 12 months, India is the worst performing market in the world. And the second worst, I will leave it for this audience to guess. You can go and find out. But you'll be
Okay.
surprised when you learn which is 19th on the list.
Okay. Let me ask you that you are bullish, but what can go wrong?
Lots of things can go wrong.
Yeah. Why don't you list at least three of them?
Yeah. So I think most of the things that can go wrong for India are outside India's control. And that makes matters worse for us, because when things are in your control, then you can fix them in advance. So, for example, our corporate balance sheets are very pristine. I
Mhm.
disagree with the common narrative that the household balance sheet is stretched. Far from it. It is not. It is actually quite okay. So there's no problem on the balance sheet. We have a massive reform tailwind. One of the things I tell foreign investors is that in India there's such low-hanging fruit. We just have to stretch our hand and pluck it, and suddenly, you will get a unleashing of growth opportunity. It's like what the government yesterday, I think, yeah, day before yesterday, proposed on the utility sector.
Yeah.
It's such low-hanging fruit. Suddenly, the entire sector can get reformed, or what it is proposing for PSU banks, or what has happened in the private banking sector, where a couple of large FDIs have happened. So this is also easy to do in this country. We don't have to do some earth-shattering legislation. These are
Yeah.
very easy steps to take, and we are taking them right now. So, given that low-hanging fruit, I think India is pretty secure on its growth outlook. But the world is looking very messy. And this is not a comment for the next 6 or 12 months, so don't misunderstand me. I have said this even 2 years ago, and nothing has happened so far. But the world is sitting on record debt and is aging. And that's not a pretty combination. I kind of agree with Elon Musk when he says that the world has a population problem which is much larger than climate change.
Yeah.
Because we as a race have not really figured out how to reverse a declining population. And we may get there before the end of this century. And after that, it is going to be problematic. What is India's biggest moat? It's all of us. It's
Yeah.
people.
People.
See, the world talks about robots, but robots don't wear clothes. They don't need drive cars. They don't eat food. They don't take vacations. All they need is metal and electricity and some circuits. So they are not consumers. And if robots start running our factories, who are they going to make things for? They're going to make things for human beings. And this country has more human beings than anywhere else on the planet. So it is the most attractive market, which is why multinationals are queuing up to access this market. Some of them will put FDI, will say, I need a factory in India. Some of them will not do that. Later on, I think they will change their view. But this is the reason why India is the most attractive place on the planet. Our estimate, Morgan Stanley's estimate, is that for the next 10, 15, 20 years, India will be one fifth of global growth, 20%. So, depending on what product or service you sell to your customer when you're a multinational company, India could account for between 10 and 100% of your revenue growth. If you're not in India, good luck to you. So,
Absolutely.
so I think India is fine. But the world is aging. The world has an indebtedness. Some point in time in the next few years, this will unfold in the form of a problem, a crisis. It may
Any
come.
other problems?
Yeah. So the other issue I think is the shifting nature of geopolitics, and I think this is going to be a difficult ship to navigate. We don't choose our neighbors, but most of our neighbors are either bankrupt, both politically as well as financially, or at least bankrupt in one form or the other. So it's a very harsh neighborhood we live in, and we
That's right.
can't change our neighbors. So that always threatens India in some way or the other, and will have to be addressed, and it'll be a difficult thing to address. Internally, if I were to say,
Yeah,
one
sure.
one thing which I think needs fixing is the farm sector. We have approximately 200 million farmers, and the farm reforms that were proposed a few years ago, I think, were extremely bright and necessary. And we need to lift our farmers out of poverty. Otherwise, what will happen is the remaining 1. 1 billion people who don't depend on farming will race ahead. And these 400 million people who get left behind will become a problem for society. So I do hope that at some stage we start implementing some durable farm sector reforms to lift this. Now, there is a huge upside potential. India has about 350 million acres of farmland, which is approximately half the country. Nowhere on the planet, I think, any large country has 50% under agriculture. And the reason why we have so much of land under agriculture is because we never got industrialized. So we have preserved a lot of our farmland, but productivity is very low. If we operated at Chinese levels productivity, I reckon that our farm economy could be $2 trillion. We could end up feeding half the world. With that, that's the potential of our farm sector, but it needs to be unlocked.
Let me turn to the non-farm sector. Corporate earnings, is that a cause for concern for you because they have not been doing too well? Is it because of internal factors or is it because of external factors? You talked about farm sector reforms. There was no labor reforms in this country for several years, although the government has been talking about it. So how do you look at the corporate earnings in a larger context?
See, this cycle for corporate earnings started with profits at 2% of GDP. And this 2% came from the previous peak of 7%, which we hit in 2009-10. From 2, we climbed to 5, and then there was a mid-cycle slowdown. The mid-cycle slowdown happened last year. I think the two reasons that would have contributed were A, RBO is running a very tight ship, and B, because of various idiosyncrasies around the election cycle, government expenditure slowed down. So we arrived in September quarter last year where the fiscal deficit had gone down from 6 to 3.4% and real rates were high. And that became the proximate reason why growth slowed down. And this all this uh, affects earnings with a lag. So the next 2 quarters tended to be bad. In February, the RBI made a pivot, and that pivot has gotten stronger and stronger. And in fact, let me state here that in April, when the RBI cut CRR and cut interest rates, double rate cut, that was very unique. In the last 25 years, it's only happened twice. One was during the global financial crisis, and then again during COVID. April 2025 did not represent any such situation. It wasn't a crisis of any sort, and yet the RBI chose to do this, which tells you the RBI's mindset has totally changed. The deregulation that they have followed up with since, I think, sets us up for a very strong growth cycle. And then the government backed it up with GST rate cuts in September. So I'll be surprised if growth doesn't turn and turn really powerfully in the next 12 months. So corporate earnings, I don't think will be a problem. I think this 5 is going to go past 7, probably 8 or 9 in the next 4 or 5 years. So if share of earnings in GDP goes from 5 to 9, nominal GDP is say 10, 11%, you're looking at 15 to 20% earnings growth. And that there is another 3, 4 years of that to come. So corporate earnings will recover, I think, in the ensuing months.
But the capacity utilization is still very low.
It's in the high 70s, and I think with the type of nominal growth that I'm sensing, we'll be into the 80s. So there will be capex also that will
Investment
come in.
that
Yeah.
will come in. Yeah.
Also, see, people are searching for more capex, but the fact is that private capex to GDP is at over 31%.
Yeah.
Now, the previous cycle peak was 39, and I don't think that is a good benchmark for many reasons. One reason is that India's productivity has improved a lot in the last 15 years. When productivity improves, you need lesser capital for every unit of growth. So the next cycle peak is unlikely to be 39. I reckon it will be more like 35, 36. The second is that the nature of capex has also changed. I mean, think about all the tech companies. They incur capex, but they don't capitalize it on their balance sheet. They recognize it as, revenue expenditure. But it is still capital assets that are being put on the ground, which have got ability to generate recurring revenue. That's the meaning of a capital asset. So some of that has also happened. But this 31, I think, over the next 3, 4 years will probably go past 35.
Okay. Okay. I'm sure that this audience is raring to ask you many more questions. So we have around 5 minutes time we
Yes.
have kept. But let me ask you one question before I turn to my audience. So please, mic should be made available. Uh, uh, if indeed, and I largely agree with you that the scenario looks quite bright going forward. If that is so, what is stopping the FBIs from investing in India? What, are they fools? They
No, no, no,
don't they
they're
see
not.
what you see?
No, no, they're not. They're not.
Yeah,
You
yeah,
see, let me make 3 points here.
yeah.
So first of all, every morning 9:15 there is a domestic bid,
Ah,
100, $200 million. Now, unless issuances exceed that bid, foreigners have to sell. It's a technical point
mhm.
because there are only three cohorts in the market. There is a domestic buyer, there's a foreign buyer or seller, and then there is a corporate issuer. So the fact is, in the last 12 months, the corporate issuances have been less than the total domestic bid. So if the domestic bid is so much, corporate issuance is so much, this is FPI selling that has to happen. Otherwise, trades will not take place in the market. Now, the key is in the next 12 months, the domestic bid, I think, remains like this. Corporate issuances will go like this.
Okay.
And then you will get FPI buying. So that's the first thing. The second thing you must remember that FPIs evaluate everything on a relative basis. So the fact is that last September, while our economy was looking very tight and was going to slow down, China was stimulating. And China actually announced its first round of fiscal stimulus exactly on 25th September, the day India peaked on a relative basis to China. And since then, China has been stimulating its economy and its growth cycle turned in a relative context, whereas India's growth cycle went down. FPIs make relative bets, and that matters in the context of this discussion. The second thing is that the last 6 months in particular have all been about AI.
Okay.
So everybody is searching for the next AI trade. Now there is an AI trade in Korea, Taiwan, China, US, obviously. I haven't found one in India as yet.
Okay.
So that I think is also bugging foreign investors. At some point in time, the AI trade will fade and it will become less relevant. India's growth has turned, and the third thing is the relative valuation. So India was trading quite expensive versus EM last year in September. Today, it is trading well below one standard deviation. So the
Okay.
valuations have turned. So I think a lot of the factors that impeded foreign investors from buying stocks in India are now turning the other way. So I won't be surprised if you'll see a bigger bid from them. But to accommodate that bid, either domestics have to sell, which I don't think will happen, or corporate issuances will rise, which I think will happen.
So we'll become more expensive.
On a relative basis, I think there's a lot of room.
Not a room.
See, China was at 9 times earnings in September last year. India was at 20. Today,
Okay.
China is at 16. India is still at 20.
Okay.
So the gap has narrowed. Now, I would argue that China needs to trade at a bigger discount because India has terminal growth, China doesn't.
Wonderful.